Hey everyone, Brian Pintar here with your weekly market update. So rates stayed pretty flat this week. I mean, it got a little worse. However, based on the retail numbers that came out on Monday, which came in way better than expected, and then some of the Fed chairman's conversations on Thursday, I would have expected rates to be much worse this week than they are. So that's a good sign they didn't move too much. A couple of things I want to point out is number one, before I talk about rates and why I think they're going to come down even before the Fed does increase and decrease interest rates. On the chart below, specifically the southwest section, it shows an index of home prices and home buyer activity. So home buyer activity is down about 10% over a year ago at this time. But here's the interesting thing. The index, the home price index, is up significantly over last year at this time. What that means is the index is anticipating that as rates come down, buyer demand is going to go up, which is going to increase offer prices. So multiple offers means higher list price, which means home prices are going to go up and they're going to go up significantly. That's something I've been saying for a long time. The chart just proves it to be correct. The other thing I wanted to talk about is interest rates. So will interest rates go down even before the Fed lowers them? Realistically, yes, they are. I mean, the reason why is it's pretty simple. It's simple math. Right now, because rates are so high, there's a lot of short-term investments that are giving large yields. So, for example, for this example, we'll just say money market accounts. Money market accounts are paying back around five and a quarter, five and a half right now, depending on where you go. So if I put my money into a short-term investment like a money market account and get five and a quarter yield, that's significantly higher, not significantly, but it is higher than what I would get if I put my money in a 10-year, 20-year long-term treasury bond or long-term mortgage-backed security. However, in anticipation that rates are going to go down, which decreases that short term yield and increases the long term yield, it's going to make more sense for investors to start putting money into these long term bonds, knowing that even though they're not making that five and a quarter, but they're getting a guaranteed 10-year return on a smaller amount as opposed to a 5.25% return on a very short term non guaranteed amount. So I fully anticipate money to start going into the bond market, which is going to help interest rates before the Fed even decreases rates. So if you have any questions, call me. Thank you for listening. I'm always here for you. Have a great weekend.